In this video, let's get an overview of the Indian money market.
The money market is a critical component of a country's financial system. It facilitates short-term borrowing and lending of funds over very short time horizons, usually less than 1 year. The money market is the part of the fixed income market for short-term funding requirements. It is like a marketplace where borrowers can receive money for their short-term requirements and lenders can make gains on their surplus funds. Participants can borrow funds in the money market, with or without any collateral, for the maximum duration of 1 year. How are the money market instruments classified? Based on the duration for which the funds have been borrowed, the money market is classified into the overnight market, where funds are borrowed for 1 working day only; the notice money market, where funds are borrowed for 2 days to 14 days; and the term money market, where funds are borrowed for 15 days to 1 year. With maturities of 1 year or less, money market instruments help governments and businesses in managing their short-term cash flow needs. Money market transactions are generally used by market participants for funding the transactions in other markets, including the G-Sec market, and meeting short-term liquidity mismatches. The money market is crucial for central banks as they conduct monetary policy by adjusting the supply and price of money or interest rates. For example, in India, the weighted average call rate is the operating target for RBI's monetary policy. We shall learn about the various instruments in the money market in another video. Given the criticality of the money market, in India, the money market is regulated by both the Reserve Bank of India and the Security and Exchange Board of India.
Money market caters to short-term funding requirements for maturities of 1 year or less. This is useful in managing short-term funding mismatches and funding transactions in other markets.